if I told you that you could skip the challenge entirely and just start trading?
I mean, I'd say you were lying to me.
Right. But welcome to episode 12 of the Joinprop podcast. I'm taking the lead today, and we're looking at something that is, honestly, it's completely upending the entire retail trading space.
It really is. It's wild.
So the mission for this deep dive is to unpack this huge stack of research you sent over to me about no-evaluation prop firms.
Yeah, the fast track.
The fast track, exactly. Imagine this. No more spending weeks in a demo environment. No more agonizing over these arbitrary profit targets just to prove you know what you're doing.
Which is like the hardest part for most people.
Oh, totally. But the premise here is you just register, you pay an upfront fee, and literally 24 to 48 hours later, you are funded.
You're just in.
You're in. They hand over a live account. And we're not talking like a few $100. We're talking 10,000, 50,000, all the way up to $250,000.
Which, okay, on the surface, that sounds completely counterintuitive to everything we know about prop trading.
Right.
Historically, the whole model, the only way these firms survive is through exhaustive vetting. They need to know you aren't going to just torch their money.
And that is exactly what we need to figure out today. Is this a legitimate financial cheat code for you, the listener, if you're an experienced trader? Or is there this massive hidden catch in the fine print?
Because there's always a catch.
There was always a catch. But to get there, we kind of have to look at the fast track versus the traditional path.
Yeah, we have to frame it because I know you all understand what a prop firm is, right?
Yeah.
You trade their money, you split the profits. But the traditional way of getting that money is just, it's brutal.
It's a massive job interview. But you're performing in a simulator for free.
For weeks or months.
Yeah, you sign up, you pay your entry fee, and you're in phase one.
Right.
You have to hit, say, an 8% profit target.
Right.
And let's say you finally hit that after 3 weeks of just like flawless execution.
Yeah.
Your reward is phase two.
More free labor.
Exactly. Another simulator. Another profit target. Maybe 5% this time. You're dodging daily loss limits. You're managing volatility. And you haven't seen a single dime.
The psychological drain of that is just immense. You're deploying your actual strategies, you're reading the macro data, and you're making zero actual dollars.
I always think of it like it's like standing in line at an incredibly exclusive club.
Okay.
You're outside. It's freezing. You've been there for 3 hours. The bouncer checks your ID, asks you all these questions, makes you wait, checks the list again. It's tedious.
Right, and you're just hoping you get in.
But the no evaluation route, that feels like walking straight up to that exact same bouncer, totally ignoring the huge line and just sliding a crisp $100 bill across the podium.
And you're just ushered straight into VIP.
Straight in. And the bizarre part is the firm is happily taking the bribe.
Yeah.
But, why? Being head of content at Joinprop, I look at this and I think, if a firm's survival depends on traders not blowing their capital, why skip the vetting?
Yeah.
Isn't that literal financial suicide?
It looks like it. It really does look like financial suicide. Until you look at the... Okay, wait, let me back up. The source material calls it the membership fee business model.
Okay.
The fundamental misunderstanding here is assuming the firm is just skipping the vetting process. They aren't.
Wait, they aren't. But they literally don't have an evaluation phase.
They don't have a simulated evaluation phase. They are shifting the barrier to entry. So instead of filtering people based on time, that grueling 2-month gauntlet, they are filtering people based entirely on capital.
So the upfront fee itself is the filter.
Exactly. They charge a significantly higher upfront premium. And the logic from the firm side is, if you're willing to deploy a serious chunk of your own money to bypass the simulator, you are implicitly telling them you're confident. The firm is hoping that if you drop a large fee, you're serious, you're experienced, you can back your own skills.
Okay, I have to push back on that.
Okay.
Because just because I'm willing to spend money does not mean I actually have the skill to trade. Look at behavioral economics, right? People take out second mortgages to buy crypto at the top of a bull run.
Not fair.
People are so impulsive. Charging me a higher fee doesn't mathematically guarantee I'm a disciplined trader. It probably just means I have terrible impulse control and room on a credit card.
No, that is a very valid critique. The fee doesn't magically bestow discipline on a bad trader.
Right.
But for the firm, the fee isn't just psychological, it's a financial buffer. We'll get into the exact math of how that protects them later, but you have to look at why a trader would even want this.
Okay, let's put the listener in that exact scenario.
Yeah, imagine you've spent 3 years backtesting a strategy.
You know your win rate. You know your edge.
Exactly. You know it works. The idea of spending 2 months of your life in a demo account, making phantom profits while taking all that daily market stress, it's completely inefficient.
So it's patience versus confidence. If you know your edge is real, that time in the demo isn't just annoying. It's an actual measurable loss of income.
Which brings us to the actual numbers. Because jumping the line is not cheap.
Just how much does it cost?
The contrast here is where the model gets wild. So the data we pulled shows a traditional $100,000 challenge account. The multi-phase one usually costs between $500 and $800.
Which is pretty manageable for 6 figures of leverage.
Right. But the instant funding, the no-evaluation 100K account, that upfront cost jumps to between $1,000 and $1,500.
Wait, you are paying double the fee?
Double, sometimes more, depending on if there's a promo running.
And the profit splits?
The splits are still huge, between 50 and 80%.
50 to 80. Okay, I look at those numbers, and my immediate reaction is just, that feels like a scam.
It's not a scam.
I'm not saying it's illegal. I'm saying it feels like one. You are paying an extra $700 or $800 just to save a few weeks. Is that actually a smart move, or are these firms just monetizing impatience?
It's both. But if you view the funded account like a consumer product, yeah, paying 100% markup for faster delivery is irrational.
Right.
But a trading account isn't a product. It's a revenue vehicle. You have to look at the opportunity cost.
Okay, walk me through the opportunity cost then. Let's run the math on a hypothetical trader.
Okay, let's say we have a trader with proven system. They consistently average a 3% return a month.
Pretty standard target for a pro.
Yeah, so on a 100K account, 3% is $3,000 in gross profit. Let's use the absolute lowest profit split the data showed, just to be conservative, 50%.
Now they keep $1,500.
Right. Now put that trader through the traditional gauntlet. Month one, they trade perfectly, they hit their target, they make $3,000.
They're in phase one.
Yep. So their take-home pay is $0. Month two, they trade perfectly again, hit the phase two target, take-home pay.
Still zero.
$0. They just spent 60 days, executed flawlessly, and left $3,000 of actual realizable profit on the table.
Just because they were locked in a simulator? Wow.
Yeah.
The opportunity cost of proving themselves is $3,000.
Exactly. Now look at the fast track. They paid the premium an extra $700 over the traditional fee. Month one, they generate that same 3%.
They take home $1,500.
Yes. They instantly recoup the extra $700 they paid for the premium entry, and they are still $800 in pure profit by day 30.
So the higher upfront cost isn't a penalty at all. For a profitable trader, paying double is just it's a negligible business expense. The math totally favors skipping the simulator.
If your edge is genuine.
If? And we know the industry failure rate. The amount of retail traders who actually pull a consistent 3% is so small.
Which introduces a totally different psychological dynamic. Like, think about the mindset shift. If you pay $500 for a demo challenge and you hit a bad streak and blow the account,
It's whatever.
yeah, the blue was soft. It was $500 and it was fake money anyway.
But if you drop $1,500 on an instant live account, you are dialed in.
Yeah, your relationship to that money changes instantly. Every pip of movement matters.
Honestly, paying double might actually be the anchor some people need. It stops them from treating it like a video game.
Or, and this is what usually happens, that exact same pressure completely shatters their discipline.
Because they're stressed about making it back.
Exactly. You throw more money at a high-stress environment, people panic, they widen their stop losses, they over-leverage, they just abandon their system trying to make the $1,500 back on day one.
They grip the steering wheel so tight, they crash the car.
Yes!
Which, okay, this is the perfect transition. If people are paying a premium, and human psychology means they're probably going to panic.
Yeah.
What stops a rogue trader from just vaporizing the firm's $100,000 on Tuesday morning?
Because they never actually give you $100,000. That brings us to the risk management framework.
The invisible leash.
The invisible leash. And it is incredibly strict. Listen to these stats. Daily loss limits are universally capped between 2 to 5% of the account balance.
2 to 5%. Okay, let's use the 2% figure. 2% of $100,000 is $2,000.
Right.
So if my open positions hit a negative floating balance of $2,000 at literally any millisecond during the day,
The automated software intervenes. It liquidates your trades and locks your account instantly.
and that's just the daily limit.
Yeah, the total drawdown cap is the real safety net. The research shows it's strictly capped at 8 to 12% of the starting balance.
Wait, so if my equity dips below, say, $92,000,
You're terminated. Permanently. You're fired.
Okay, that completely reframes the whole product for me.
Yeah.
It's like a parent handing a teenager the keys to a brand new Ferrari.
Love this analogy.
You get to sit in the driver's seat, you can rev the engine, show off to your friends. But the parent secretly installed a digital speed governor under the hood.
Right.
The second the speedometer touches 45 miles per hour, the engine just dies. You have the car, you look cool, but you absolutely do not have the freedom to actually drive it.
That is exactly it. The account size is an illusion. And when you look at the math of that drawdown cap combined with the upfront fee, the whole no evaluation thing just dissolves.
Okay, wait, let me back up. I didn't explain that right. Or rather, I need you to unpack that math.
Okay.
Because this is where the reality of the industry gets crazy.
Okay, look at the firm's actual risk.
Yeah.
They tell you they're handing you $100,000. But we just established that if you lose $8,000, they cut you off.
The software severs access at $92K.
Right. So you do not have a $100,000 account.
Oh, wow.
You have an $8,000 account wrapped in $92,000 of inaccessible leverage.
That is wow. The firm is never actually risking $100K on a stranger. Their max theoretical risk is $8,000.
But wait, it gets deeper. Factor in the fee.
The $1,500.
Yes, you pay them $1,500 in cash just to open the account. If their max exposure before the software kills the account is $8,000, and you already gave them $1,500, their true out-of-pocket risk on you is only $6,500.
$6,500. That's it.
That is literally their entire exposure.
So the evaluation phase isn't being skipped at all. It's just happening live. The firm has insulated themselves so heavily that they can afford to let you trade live.
Exactly. And those daily limits and drawdowns are just the foundation. The source material outlines all these other layers, like position sizing restrictions. You can't just risk your whole $8,000 buffer on a news event.
Oh, the news trading bans. This is one of the most controversial rules in the prop firm space. Yeah. And I would hear traders complain about this. They're like, why does the firm care if I trade during the non-farm payrolls as long as I have a stop loss? If my stop loss is set to risk $1,000, I should be able to trade whatever I want.
Well, because a stop loss isn't a magical force field.
Yeah.
We have to look at how market liquidity actually works.
They're just looking for reasons to terminate accounts, honestly.
Yeah.
It's just an excuse.
No, they have to protect themselves.
From the people they invited in. They charge them a premium, give them the account, and then ban them for trading during the best volatility.
But listen to the mechanics of it. During a major red folder event, like an FOMC rate decision, the market makers, the big liquidity providers, they pull their limit orders. They step aside to avoid the chaos.
Right. The order book empties out.
Exactly. And when the book is thin, price doesn't move smoothly. It gaps. It literally teleports from one level to another. So say you have a stop loss placed representing your $1,000 risk.
Okay.
The news drops. It's totally against market expectations. The market violently moves against you. Your stop loss triggers. But a stop loss is just a market order that says, get me out at the next available price.
Oh. And because the liquidity is gone.
The next available price might be 40 pips away from your stop loss.
What?
Massive slippage. The automated system tries to close you out to protect the daily limit, but because of the gap, you don't lose $1,000. You lose $3,000 before the system can physically execute the exit.
The firm's software gets bypassed by the actual physics of the order book.
Exactly. Which means the firm could theoretically lose way more than their $8,000 buffer if someone is heavily leveraged during a spike.
So they just blanket ban it to prevent the math vulnerability. If you hold an open position within like 2 minutes of a major release, you're flagged.
And a rule breach usually means immediate termination. The invisible leash does not care about your intentions. It doesn't care if the trade was profitable. It only cares about protecting the firm.
When you put all this together, the premium fee, the 8% cap, the 2% daily limit, the news bans, it operates like a risk pool.
It's basically an insurance company.
Yeah. In insurance, the premiums from the majority cover the claims for the minority.
Exactly. In this space, the entry fees from the impatient, underprepared traders heavily subsidize the drawdowns and the payouts of the disciplined minority.
Wait, that's literally their business model?
That is the model. The trader who pulls an 80% split on a $10,000 gain, they aren't getting paid from the firm's corporate treasury. They're getting paid by the 10 traders who registered yesterday, hit the daily loss limit, and forfeited their $1,500 fees.
It's a closed-loop ecosystem. The firm is just a really sophisticated risk manager taking a cut off the top.
Yep.
Which brings us to the most critical part of this whole thing. If the environment is engineered with such a microscopic margin for error, how does anyone survive?
Right.
If you are staring down a 2% daily limit, how do you actually extract money?
Well, the research gave us a survival playbook for this. It highlights specific trading styles, systematic approaches, risk-adjusted scalping, and breakout trading.
So you have to pause on that, because my immediate reaction is that contradicts the rules of the environment. If your daily loss limit is a tiny 2%, why would the research recommend something inherently aggressive, like scalping or breakout trading? Scalping is high frequency. One violent twitch in a market, you hit 2% and your $1,500 is gone.
The contradiction only exists if you use traditional retail risk parameters. The crucial words there were risk-adjusted and systematic.
Okay.
You cannot rely on intuition here. You can't just look at a chart, feel a bullish bias, and throw a standard lot size at it.
Because a standard lot size carries a dollar per pip value that is way too heavy for the invisible leash.
Exactly. Systematic means the edge is mechanical. Your entry, your stop loss, your take profit, it's all defined by a strict set of rules before you even open the terminal. No emotion.
And the risk-adjusted part.
Okay, let's illustrate. A normal retail trader with their own 100 grand account might risk $1,000 1% on a single scalp. If they lose, they're down 1%, no big deal.
But if a prop firm trader risks $1,000 and loses, they're instantly halfway to getting fired for the day.
The pressure of knowing your next trade could cost you your whole funded account is paralyzing. So a risk-adjusted scalper under prop rules doesn't risk 1%. They risk fractions of a percent.
Like 0.2%.
Right.
$200.
Right.
But risking $200 on a $100,000 account sounds so conservative. If you win, your payout is tiny.
Because the goal in the beginning isn't to make huge withdrawals. The immediate objective is survival. You have to build an equity buffer.
Okay, walk me through the mechanics of that. How does a trader physically build an equity buffer?
It's about manufacturing breathing room. Go back to the starting parameters. 100K account. Termination at 92K. Your buffer is exactly $8,000.
The leash is tight.
So for the first week, the professional ignores the huge profit split. They use their risk-adjusted strategy with micro position sizes. They risk 200 here, 300 there. Base hits, not home runs.
Because base hits don't threaten the daily limit.
Slowly, they accumulate small wins. By the end of week 2, the account balance is at $103,000.
They generated $3,000 in profit.
Now look at how the math shifts. The firm's hard termination limit is still static at $92,000.
Right.
But the equity is $103,000. The trader just organically expanded their breathing room from $8,000 to $11,000.
They insulated themselves with house money.
Exactly. Once that $3,000 cushion is there, normal market variance isn't an existential threat anymore. They can mathematically afford to increase their position sizing back to normal because a loss just eats into their profit, not the core drawdown limit.
They push the invisible leash further away from their neck.
That's the secret.
That is just, it's a masterclass in risk mitigation. But the reality is, the vast majority of people paying this premium fee do not do this.
No, they don't.
They pay $1,500 because they want money right now. They get their credentials on a Tuesday, and on Wednesday morning, they throw a massive position on gold, hoping for a $5,000 payout by Friday.
They're sprinting in a minefield. The asset spikes, they hit the 2% limit, and the software locks the account.
The firm collects the fee, the capital is gone, and the cycle repeats. It really is a tax on impatience.
It totally is. And that's why the playbook emphasizes documenting everything and sticking to the system. But there's another layer to the playbook that honestly blew my mind.
What's that?
It shows how fragile this whole environment is, even for the disciplined traders. The research explicitly says traders should maintain relationships with multiple firms.
Wait, why? If you've secured a 100K account with a good firm and you built your equity buffer, why split your focus? That sounds distracting.
Because you are never fully in control. You are on their servers, under their algorithmic enforcement. Go back to the news event scenario. You're disciplined. You have a $5,000 buffer. You're trading perfectly. But you have a lapse in focus, or the terminal lags for a microsecond, and you accidentally leave a micro position open during a Fed rate announcement.
You breached the news hour rule.
And the trade might actually win. But the compliance software detects the timestamp overlapping with the restricted window.
And the software has zero nuance. It doesn't care about your buffer. It just detects the breach and terminates you instantly.
Everything. Your revenue stream, your buffer, your access vaporized over a technicality.
So the professional response to that fragility is just structural diversification.
Yes. Pros don't rely on a single point of failure. Instead of one 300K account at firm A, they buy a 100K account at firm A, another at firm B, and a third at firm C.
But manually executing the exact same scalping strategy across 3 different platforms simultaneously, that's logistically impossible.
Which introduces trade copiers.
Trade copiers.
This is wild. It's third-party software that uses API keys to link the accounts together. You designate one account as the master, the others are the slave accounts.
Wait, really? That is insane. I need a second to process that.
I know, right?
So when you click Buy on the master account, the software instantaneously replicates that exact execution across firm B and firm C.
It duplicates everything. Entry price, stop loss, position sizing it. It even adjusts automatically for the different account balances.
Oh my God. By using a copier, you're spreading your regulatory risk. If firm A's automated software trips you up on a slippage event or a technicality, your livelihood isn't paused. The master account might get terminated, but firm B and firm C are totally unaffected.
They're still generating revenue.
It's an arms race.
Yeah.
It really is a technological arms race. The firms deploy algorithms and microscopic limits to protect their capital and harvest fees. In response, the pros deploy trade copiers and systematic micro-risk scaling to bypass the leashes.
It's a massive, multi-layered tug of war. And understanding that completely recontextualizes the whole no-evaluation narrative.
So when we started this, we asked, is this a financial cheat code or a hidden catch? And the answer lands right in the middle.
Definitely.
The marketing is so seductive, bypassing weeks of grinding to get massive leverage in 24 hours. It's an incredible pitch, and the leverage is real. The payouts are verifiable.
The tool itself is objectively powerful.
But it's a tool with razor-sharp edges. It requires an almost robotic level of discipline. It's an ecosystem built for professionals who know how to walk a mathematical tightrope. If you're an amateur or if you panic with live capital, paying double to jump the line is not a shortcut to wealth.
No, it's just a highly efficient way to donate your money to the firm's risk pool.
It is the ultimate test of self-awareness. You have to know if you are the disciplined minority or the impatient majority.
And that actually leads to the final, most provocative thought from all this research, something for everyone listening to really mull over.
Lay on me.
Go back to the core math of the membership model. If the upfront fee is $1,500 and the software cuts you off at an $8,000 loss, are these prop firms truly risking their own capital to back you?
Oh, wow. Or are they just operating as highly sophisticated risk pool managers?
Exactly. Are they just using the premium entry fees of the impatient 90% to fund the profit withdrawals of the disciplined 10%? That forces you to completely question the product. Are they selling you trading capital, or are they just selling you access to the risk pool itself?
They're shuffling entry fees, relying on statistical failure rates, and taking a massive margin for providing the software architecture. It's a brilliant business model, but it fundamentally shifts how you should view your relationship with them.
It totally strips away the illusion of the benevolent institution handing out $100,000 checks. It replaces it with this cold, calculated mathematical reality.
It really changes how you look at those instant funding ads on Instagram.
On that highly analytical note, we're going to wrap this up. For you listening, the takeaway is absolute. The fast track exists, the capital is there, but the guardrails are sharp. Do not let impatience dictate your decisions. Read the fine print, understand your real risk limits, and if you take the leap, spend your first 2 weeks meticulously building that equity buffer.
Don't jump the line just because you're tired of waiting. Jump it because your system is proven, your discipline is mechanical, and you're actually ready. And as a baseline rule, understand the order book liquidity. Just stay out of the market during the Fed announcement.
Seriously, just step away from the keyboard.
Absolutely. Protect your capital, respect the invisible leash, and we will catch you on episode 13 of the Joinprop podcast.